If you're on social media and watch finance content, you won't have to look far to find people raving about dividends for passive income. What's more to love than getting paid to do pretty much nothing? Well, as is often the case, there is actually more to it than meets the eye. So in today's video, I want to talk about some of the problems with dividends that are often brushed over. I know a lot of people are passionate dividend investors, and from the outset, I'm not saying don't invest in companies that pay a dividend, because lots of these are great companies. I just personally wouldn't base my investing decisions solely on the fact that a company pays a dividend. For example, dividends can be great for someone in retirement who doesn't want the risk associated with growth stocks. So anyway, feel free to let us know your thoughts and whether you agree or disagree with me in the comments below. If you're new here, then my name is Ollie, and on this channel we discuss all things related to personal finance and investing and how to reach financial freedom. If that sounds like something you are interested in, then I recommend you subscribe as I upload new content every week. Also, before we get stuck in, I must be clear that nothing in this video is financial advice, and if you want financial advice, then you should seek a licensed professional. So the first problem is that the dividends have to come from somewhere. So it's worth understanding that by being a shareholder of a company, you own a little piece of it. And by being a shareholder, you have a shared right to the company's assets. Therefore, if, for example, the company goes bankrupt, then you and all the other shareholders get to split the cash and whatever other assets are left over after other creditors get their share also. And so when a company earns money and it's added to the company's bank account, you already own that money. If the company decides to pay a dividend, you don't technically gain anything as an investor, because technically the company takes the profit from the bank accounts that you already part own with everyone else and simply just pays you out a part of the profit in cash. And so the company's bank account value drops by that same amount that they just paid out. Therefore, you own the same amount of wealth as before the dividend was paid. Just that after the dividend, the value of your investment is lower and instead you have some cash. The XD date is the last date that shares can be purchased to receive a dividend. And after this date, this value is lost from the company. And the company is worth less to potential new investors because they are not eligible to receive the dividend and so are unwilling to pay a premium. Therefore, the share price will reflect this and drop by the amount of the dividend. As an example, say McDonald's is hypothetically $100 a share and they are paying out $1 of dividends per share. When the company goes past the ex-dividend date, it will be worth $99. It's worth bearing in mind though that while this often is the case, the stock market is a free market and the stock could still be worth $100 or more depending on what people want to pay at that point in time or just due to current market fluctuations. But as a dividend investor, you are often told to reinvest your dividends back into the company. So losing that value shouldn't really matter. Well, this is where the next problem comes in, and that is tax. Dividends are taxed in most countries. Obviously, this depends on where you live and whether you are using a tax wrapper that may give you some kind of tax break, but taxes will often be between 15 and 40%. It's worth noting that taxes can change at any point, so always do your own research, and none of this is financial advice, but in the UK, if you use a stocks and shares ISA, you can get all your dividends tax-free, but if you receive dividends outside of this in a regular account, then you get a £2,000 allowance tax-free. But after that, it depends on your income tax band, which ranges from 8.75% up to 39.35%. Alternatively, if you're in the US, you can invest using a Roth IRA account and the dividend income is tax-free. However, if you use a regular account, then you still owe taxes depending on your filing status and income bracket. But following on from this, say you are taxed on your dividends and you want to reinvest your dividends each time. For the sake of this example, let's say you are taxed at 20%. Well, that $1 you receive as a dividend will only be 80 cents reinvested. Then when this money you invested earns dividends also, these will also be taxed at 20%. So the 80% you reinvested loses another 20%. And then the dividends you receive are now only worth 64% of the value of the first dividend paid to you. If you reinvest this again, you lose another 20%, and so forth and so forth. It's worth noting this doesn't even include trading fees, if you're unfortunate to be at a broker that doesn't offer commission-free trading. So if you are at one of these brokers, then prepare to lose even more money. So the next problem with dividends that is often brushed over is that to earn a lot of money through them, you need a hell of a lot of money invested. If you wanted $1,000 a month from dividends, then say you found a company paying a 5% dividend, then you would need $240,000 invested in that company. But in reality, 5% is actually pretty generous and at the higher end of the scale, with more often dividends being in the range of 2 to 4%. So at 4%, you would actually need $300,000 invested. 3% you would need $400K invested, and 2% you would need $600,000 invested just to get $1,000 a month. I don't know about you, but I personally don't have 3 to 600K lying around, and even if I did, I wouldn't want to put that amount into one company unless I was a multimillionaire. And even with that said, I would need more than $1,000 to live off each month. So the amount I would personally need invested for a livable sum would need to be a very large sum. And even worse is the fact that dividends are not guaranteed. Even though a company pays a dividend this quarter, there is no guarantee they will pay the same amount next time, and the dividends can even be suspended by the company at any point. This is not great if you are retired and dependent on this payment to pay your bills. Now, before we go any further, if you are getting any value from this video, then please don't forget to give this video a like, as it helps my channel massively to reach more people and helps me to make more content like this. So the next problem with dividends is that when a company decides to pay them, it's almost as if they are saying that they don't have any better use for that money. Whereas in reality, this could have been used for many other things. For example, it could have been used to pay off debt, it could have been used to possibly acquire other companies, or it could have been used to hire more skilled staff. They could have invested it in R&D or marketing, or they could have even held on to this cash in case they had an idea in the future. Or even better than paying a dividend, they could have even been used for share buybacks, which are not taxable and in return reduce the number of available shares, and so your shares become worth more money. There are so many alternatives to paying a dividend. So the next problem with dividends is if you quickly Google high dividend yield stocks, you may see a bit of a pattern that there are quite a few tobacco companies or even fossil fuel based companies. Now, I'm not saying all dividend paying companies are in these industries, or even all high dividend yield companies are in these industries, but high dividend yields are often a bad sign for the future prospects of a company because the industry may be dying out, and often they pay a high dividend to sometimes attract investors and prevent the share price from going down sooner. This brings us to the next problem, which are dividend traps. A dividend trap is a high yield dividend stock whose payout is simply too good to be true or unsustainable. Sometimes this is done to attract new, less educated investors. The problem with this is that the company may be paying dividends with money that they don't have, and so going into debt to pay these dividends, which could eventually result in them not having enough money to run the business. There are ways to spot these though. Firstly, compare the dividend yield against other companies in their industry and see if it's a lot higher than the rest. If it is, then you may want to take a closer look. Another handy way to spot them is by looking at the payout ratio, which is a stock's dividend against its earnings. If a stock earns $5 per share and pays out a $1 dividend, then its payout ratio is 20%. If you see a payout ratio exceeding 100%, then it means the company is paying more than it earns, which is generally unsustainable. So make sure to do your research, as otherwise you could end up losing all your money if the company goes under. Let us know in the comments below if you actively pick dividend paying stocks or if you would rather own growth stocks. Also, if you are a dividend investor, let us know your favourite dividend paying stock below. Now, while I have shared these negatives, I personally think dividends are great for people nearing retirement. Not that that's financial advice, but they will be something I use later in my investment life and head towards retirement personally. In fact, more than 80% of companies in the S&P 500 pay a dividend. It's just worth understanding that it's unfortunately not free money. But whether it's growth stocks or value stocks you're investing in, having more cash will allow you to grow your portfolio quicker. And you may be wondering how you can save 100k fast. So I recommend you watch this video next. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll hopefully catch you over here next.